the question is it realistic to expect a Fed pivot early 2023, given the forward path of inflation? We don't think that's actually justified. Yes, there's evidence that inflation may have peaked in the US. I think Europe and the UK are lagging a little bit, but the path going forward is not going to be a straight line. It's highly uncertain. And then more importantly, it does require growth to slow down. You can't tame inflation without, having growth slowing down a bit more. And not to make things circular, but, there's also an argument to be made that too much easing in financial conditions driven by tighter spreads, higher equities, et cetera, at some point can become counterproductive a little bit and push the Fed to lean against it. So to your question, yes, it's been a powerful driver, but we would fade it.
One interesting thing about the credit spread widening that we had just a couple of months ago is it wasn't really accompanied with a pickup in defaults. So how is that looking? How is the landscape looking when you think of potential defaults, particularly in high yields, which you said has actually performed very well in the US?
Yeah, no, that's exactly right. I mean, most of the repricing has been driven by a higher risk premium as opposed to a pickup in defaults or downgrades from investment grade to high yield for that matter. We don't expect that to change. I think fundamentally, and this has been a very solid anchor to credit markets, both in the US and Europe, the market is in great shape. Companies have done a very good job strengthening their liquidity positions back in 2020 and 2021. Keep in mind that the vast majority of the debt that was raised the last couple of years is actually still sitting on corporate balance sheets in the form of excess liquidity. So that's a very nice line of defense in case things deteriorate further from here. And then, you've had some pretty nice passive deleveraging too. Leverage ratios have come down a little bit. So even if the economy goes into recession, and we do expect Europe to experience a technical recession in the second half of the year, but even if the US follows suit, I don't think you'll see the typical pickup in defaults that you see in a recession.
Well, let me pick your brains on Europe, given a couple of things that you said. Reading between the lines, it sounds like you're a little bit more cautious on European credit here. How relevant for European credit is this new anti-fragmentation tool that was introduced by the ECB, the TPI mechanism? And is that something that you think is actually going to put a cap on where spreads can get to?
Yeah, that's exactly how we think about it. I think it's good news in the sense that it limits downside risks. It puts some kind of a ceiling on spreads. It also limits the risk of contagion to adjacent markets like corporate credits. Banks in particular tend to respond very rapidly to an abrupt move wider in sovereign spreads. Does it create the kind of upside that QE created back in 2016, 17? Probably not. And so we would view it as a put option, but certainly not something that creates upside. At current levels, BTP spreads are around 215 basis points. We think 250 is more reasonable here. And so there's definitely room for some widening there.
They're actually 220 today, Lutfi. They're moving a little bit wider, but point taken. Yeah, so there's definitely some room for a further widening in that BTP spread. Just to ask you a more, I guess, broader question from a sectoral perspective, what we've seen, say, in Germany over the last month is a bailout of Uniper. Today, we've had these wholesale numbers come in extremely high. There's lots of concern about the future of German industry from here, especially when it comes to industries that are heavily reliant on power as an input cost. How do you view that sector? And is it something that you just want to stay away from at this point in time, because we have yet to see how these higher inflation numbers are going to translate into the German industry?
Yeah, I mean, look, Germany and Europe more generally are experiencing a pretty severe supply shock. The magnitude of that shock and the persistence of that shock are still highly uncertain. And so we would definitely pivot towards sectors that are more immune to that kind of headwinds a little bit. But our sector allocation in general has been favoring things that are more defensive, that have the ability to withstand a combination of slower consumer demand and then potential headwinds to margins from higher input costs, higher wage inflation, et cetera. There's one sector that we actually like where we think there's a lot of value here. It's banks. Banks have been a big underperformer this year, both in the US and Europe. There are reasons for that, but in terms of how much premium that sector has rebuilt, it's built enough premium in our view to justify an overweight allocation there.
And then a final question on issuance. Clearly, interest rates are moving higher all over the world. Central banks are tightening, etc. Did you get the sense that corporates were trying to get as much issuance out as possible to preempt the move higher in yields? What has happened in that space?
Yeah, well, actually, this year has seen a pretty steep decline in primary market activity. I think high yield has been the extreme version of that, both in the euro and the dollar market. High yield new issue volumes are down 75% on a year-over-year basis, which is a historic collapse. And then net issuance is actually negative in the US and barely positive in Europe. I think that will remain the case. You know, most companies are still sitting on enough excess liquidity that does allow them to kind of wait a little bit for vol to come down and potentially yields to go down a little further here. But between now and the end of the year, I don't think you'll see a big uptick in primary market activity. I think it'll be more of the same, which is pretty light.